the goal of starting a company is to get it growing and profitable, and that defines success, not how much you raise and who you've raised it from.
Welcome back to another episode of Tank Talks. I'm your host, Matt Cohen. On this week's episode, we welcome Dave Lambert, founder and managing director at Rightside Capital Management, who's shaking up the venture capital world with a fresh and data-driven model. In this episode, we cover pre-VC investing, how focusing on ultra-early deals helps find hidden gems before they hit big rounds. We also talk about Dave's quantitative approach, using data over gut feelings, and making decisions in a week or less to make an investment. Next, we talk about Dave's ultra-diversification approach, spreading bets across a wide array of startups, trying to find the power law returns in some of the startups he invests in. Next, we get Dave to talk about his visions around investing early at very early entry prices, sometimes below $2 million, and how that helps him drive better returns for the fund. And lastly, we talk about how emerging tech and AI is changing both how startups operate and how investors are placing their bets. Now, let's jump into the tank for this week's episode with Dave Lambert from Rightside Capital Management. Thanks for joining us in the tank today, Dave.
Okay, thank you. Great to be here.
You know, Dave, you have an incredible story that I think a lot of our listeners are going to enjoy. But for some of our audience that don't know you so well, can you give us a brief background on yourself, where you grew up, your early career highlights, and how you got the idea for Rightside Capital Management in the beginning?
Yeah, definitely. So I grew up in Denver, Colorado. I came out to the San Francisco Bay Area for college, was here 1988 to 92, going to school. And then I was basically a career entrepreneur after then. So graduated in 92, started a computer hardware company called Acorn Computer in the Bay Area, sold to mostly the corporate world. A lot of our customers were the first generation of dot-com companies that grew and exploded upwards in the 1990s and then crashed down in a ball of flames early 2000s. And our revenue shot up and shot down accordingly as well. In the early 2000s, while I was still running Acorn, I also co-founded a software company called WorkMetro. We did locally branded job boards across the US, mostly up and down the East Coast, sites like workbaltimore.com, workpittsburgh.com. And during that time, I'd say from the mid-90s to mid-2000s, I was also a somewhat active angel investor.
And so you were in the picks and shovels a bit too, right? So you had the chance to see all the early days of like the first software creations and then also maybe not the ones that had the right timing.
Completely. So I was here in ground zero with all the craziness of the first dot-com bubble, which dwarfs anything we've gone through in the last 5 or 6 years here, I would say. My first company was largely bootstrapped. My second company, we raised money from angel investors, Angel Group, some large Bay Area venture capital firms, and I had some angel investor experience. So that's sort of my life up until the late 2000s. And then that last company sold to a competitor in early 2008. And then around that same time, I was talking with a friend that I had from school, whose name is Kevin Dick, who's one of my partners and co-founders. And he had the initial genesis of the idea for Rightside Capital. And he got that idea when he was reading a book called The Black Swan by Nassim Taleb. And the whole fundamental premise of the book is that really it's these outlying events that have the largest impact on people's lives. And the book couches Black Swan events as these negative events, that they're these outlier events that in foresight seem impossible to happen and incredibly unlikely. And then after they happen, everyone weaves this social narrative that makes it such that everyone feels they're obvious in hindsight and everyone knew they were going to happen. And his epiphany at the time was that most really successful tech companies are effectively positive black swans. And if you go back to that time, you can look at sort of Google and Facebook as great examples. So when Google launched, in reality, search was viewed as a pretty solved and crowded market. There were a lot of search engines and options out there. And probably the last thing anyone thought we needed was another search engine. But then they were wildly successful. And just a few years later, everyone was talking about how everyone knew search was ripe for disruption. And I would say Facebook's sort of a similar story. We had Friendster and MySpace, and sort of the last thing that people thought we needed was another twist of those. But Facebook was wildly successful, being able to put are you single, married, available, made a huge difference, as did some other things. And just a few years later, everyone's talking about how it's obvious Facebook would be successful. So that was sort of the initial epiphany that you can't really tell in foresight what's going to change the world and what won't. And that if you could capture the returns from those at the very earliest stages, that would probably make up for all your losers. And basically, we realized really early when we started doing the math that it was a power law distribution with a really steep shape curve, and that a lot of the basic sort of normal rules of math and regular reasoning didn't apply. And we sort of built an entire investment model around that. And it was sort of an idea on paper that we noodled around. And then we raised our own angel round and started doing some research in the very late 2000s and went live in the early 2010s.
I mean, great time to go live for sure after the global financial crisis. But, Black Swan events typically relate to like macro events, or they're not very specific to individual companies. Like attributing a Black Swan correlation to an individual company is not really what I think the definition of Black Swan usually is. It's something that comes out of left field on a macro level that kind of sweeps everyone off their feet.
No, from the book's definition, a Black Swan event is really just something that has a massive impact that in foresight is viewed as incredibly unlikely to happen, or almost impossible often to happen, and then actually does happen. And it doesn't have to be a massive macro event. It could be just a war breaks out in your small community between your city and the city next door or something like that. Or it could be all the family but you gets wiped out in a car crash. Like that's a personal Black Swan event for you. It could be you winning the lottery. It could be something that you had invested most of your money in being a fraud, and suddenly your net worth goes down by a crazy amount. It's basically the tails of the probability, distribution curve that we heavily discount, but that do come into play somewhat regularly. And the big insight that we had is that...
Yeah, I guess everyone has a different view of it.
And that the book's largely written with Black Swans being negative events. And so this is late 2007, early 2008. Kevin and I start talking about this. We actually reached out to Nassim Taleb, the author, talked with him. He actually thought it was very novel that we were thinking of the concept of Black Swans as positive events and not just negative, and agreed that all the same characteristics work and are there for a positive Black Swan as opposed to negative. And actually at that time, the term Black Swan didn't have such a negative correlation. It wasn't until the global financial crisis hit later that year that it really became a negative term.
Right.
But the basic premise of what we do is that you've got to capture these tail outliers. And, to do that with high certainty, you have to have massive diversification. And we also believe that you have to have an investment philosophy that factors in that it's hard to really screen in or out these Black Swan events, because the more you try to screen the other stuff out, the more you're likely to screen out the Black Swans, because the things that are revolutionary also look ridiculous in foresight.
Right. I mean, it's an unbelievable approach to venture capital that inspired you by taking this negative concept of Black Swans and turning it into a positive sort of non-conventional way of doing investments in VC, pre-revenue, pre-product, sometimes early stage companies. But can you maybe explain to our listeners like how Right Side Capital leverages, the power law and massive diversification, and also this like structured way of finding positive Black Swans into a VC fund strategy?
So, I mean, the sort of layman's terms on sort of how the math works on the background is that these very early stages of the venture investment world, and certainly when you're investing in really small rounds like we do, sub $500,000 rounds, most of your returns come from this, a very small percentage of your investments. It might be the top 1% to 5% of investments. And let's turn that into a more sort of palpable number. A 5% outcome is a 1 in 20 outcome, and a 1% outcome is a 1 in 100 outcome. So you could be, one of the best investors on the planet. And if you build a portfolio of 20 or 30 companies, maybe you'll get 2 1 in 20 outcomes because you're better than average. But you'd still have to get incredibly lucky to get a 1 in 100 outcome. So what we did is we did a lot of work to figure out how skewed is this distribution of returns, and how much diversification do you need to smooth out the risk curve? And the answer is you need a lot. You need generally hundreds of investments. And what happens is if you have a fund that has many hundreds of investments instead of tens of investments, suddenly you don't have to get lucky to get those 1 in 100 outcomes. If you have 500 investments in a fund, you're going to get 5. Maybe you get 4, maybe you get 6, but you're going to capture them with high certainty, and you're going to have, dozens, a couple dozen of the 1 in 20 outcomes. And so basically it's a strategy that's built around capturing these positive black swans with high likelihood. And then the next part of our thesis, which is really sort of goes against the grain of the venture world, is that we use this quantitative data-driven selection process. So when we launched, most companies we invested in were still pre-revenue. So we're evaluating supposed business models, characteristics of founding teams, expected price points, things like that. As we got to the mid-2010s, almost everything we're investing in from then till now has revenue. So we can look at real numbers and metrics. And we basically gather up data points about a number of metrics that vary by business model. And then it's a pretty quick yes or no based on those metrics and the valuation at which we can invest, founding team characteristics. And it's just very different. One of the things we've done is we've systematized the process that we're not allowed to use our subjective judgment. So we can't factor in whether or not we think an idea is crazy into our yes or no decisions. And we decided that very early on in our firm's existence, because if you don't do that, it's impossible to keep that subjective analysis out of your process.
Okay, so how many qualitative and quantitative questions are you asking a company on average?
In today's world, at the very high level, across sort of all business models, the most important things we're looking at are what's your revenue? What's your revenue growth rate? What's your current cash burn? How much cash have you burned through to get to the state at which you're at now? What is your business model? What is the price point? What are the characteristics of the founding team? I would say that we're looking at across every business model, regardless of whether it's B2B.
A lot
B2C.
of those are quantitative, though, in terms of the company has to be existing.
Oh, those are all quantitative. That's all we're looking at.
Yeah. So that would clearly knock out angel or even pre-seed companies that are pre-product or pre-revenue, like what we do.
So we mostly invest in companies that are raising small funding rounds. So sub $500K rounds. Most companies rounds we're investing in are $200,000 to $500,000 funding rounds. They're companies that already have a live product generating revenue. Usually they have somewhere between 5,000 and 30,000 of MRR. And they're pretty capital efficient. And we're investing at low valuations, usually between $2 to $4 million valuations is probably 80% of what we do.
And these are non-coastal companies, or sometimes they're Bay Area as well?
Mix of everything. I would say if you asked us in the early to mid 2010s, we were very strongly not Bay Area because it was so much more expensive to be a startup here. And largely that was because at that time in the startup world, most of your tech team was where your company was based, and tech employees are very expensive here. In today's world, it's not that uncommon for us to come across a 2 or 3 person founding team here, but they've got 8 devs overseas or in some other part of the country, and it's still pretty capital efficient.
So you're doing, what's the average check on those 250 to 500K rounds?
On our check size is usually 150 to 300.
Got it. And again, so ultra diversification is the play here. So give our audience a sense of actually how many companies you will have in a portfolio.
Yeah. So each of our funds has many hundreds of companies, typically 500 plus.
Many hundreds. Right. And there are usually one check at the beginning of, call it 100 to 200 at a $2 to $4 million valuation. So you're buying, a percent, maybe 2%. And you've got a couple hundred of these in the fund.
Well, yeah, it depends. If we're 150 at $2 million valuation, that's, more like 7%. And if we're 150 at a $4 million valuation, that's more like 3 to 4%, upfront. We are not percentage focused at all. That's something that's also a little different. All we care about is sort of what's our expected multiple return. So we don't eliminate.
And you're typically not leading, obviously, with those check sizes.
We lead almost every round that we do. Because remember, we're not just, I'd say the big difference between us and a traditional pre-seed firm is there's a lot of pre-seed investors out there that will write 200 to 300K checks, but they're writing that into $1.5 million rounds on average, sort of $1 to $2 million pre-seed rounds. We're writing a 150 to 300K check into often 150 to 300K total round sizes. That's the big difference. So the total round size is just
mostly safe notes, I assume, as well.
Yeah.
Okay. And so the numbers don't lie, though, right? You've got numbers to back up this strategy. Can you share some insights with our listeners on how this massively diversified portfolio has delivered power law, and what some of your biggest returns have been driven by?
Yeah. So we're on our fund 6 right now. Our funds are all of our funds actually have incredibly good returns. Because we're fundraising from an SEC perspective, we're SEC registered. I'm actually not allowed to give our actual return numbers, though I'd love to. But I can give you some ideas of like an example of a big winner and how we would evaluate it and how a regular venture firm might have looked at that same company and sort of run the other way. So let me take a company from our Fund 1, which is actually our biggest winner from our Fund 1. It's a company called TradingView. They are a consumer fintech company that's sort of a freemium / subscription business model for all at-home consumer users. We met them in the early 2010s when they were going through Techstars. And at the time, they had about $12K a month revenue, which was very unusual. And they had a 3-person founding team, which were founders from Ukraine and Russia. They had a freemium business model. It was a model where just a very few % of people, paid, as with most freemium business models, and they generally paid $15 to $30 a month. So at a really high level, if you're looking at that company from a venture perspective, it's sort of scary and very uninteresting because it's, all right, here's a business model targeted to active at-home traders that are trading commodities, currencies, and stocks. And your first question would be, what's the TAM? And you're like, how many of those even exist in the world? And then how big can your market be when it's only 1 to 3% are paying you and they're just paying you $15 to $30 a month? Right. So from any of the traditional venture analysis, you'd say, I don't like the target market. The market's too small. I hate the freemium business model. It's founders from overseas. And, some of them I can't even speak to so well because their English is just okay. And so it just wouldn't be a fit and you'd go the other way. But from our perspective, when you're looking at it at a quantitative, in a quantitative way, it checked all of our boxes. So they had an unusually large amount of revenue for a company at that point in time. They had bootstrapped themselves up there. So they had raised $0 prior to then. They had a founding team of 3 people, each of whom had somewhere between 10 to 15 years experience each doing financial charting technology development. And when you asked anybody, they just had the best technology on the planet for financial charting. We didn't understand necessarily what made great financial charting software or not, but we got validation that was the case. And they were operating just about break even because they had a large team of overseas developers working on it. And so from our perspective, that just checks all the boxes of an attractive profile at the valuation that we invested. And we didn't factor in at all what's their business model, what's the price, do we like freemium or not? How big can this market get? Because when you get consensus about those things, those are areas where you just have lots of competitors if you're successful. It's when you make that investment and it's sort of not consensus, when it looks like a crazy idea and it looks like a small market, but it turns out everyone's wrong and it works and it's a much larger market than anticipated. That's when a company can operate for years with relatively low competition. And I think that's what happened here. The company blew up and, when we sold out, it was worth billions of dollars. And I don't think at the time anyone would have projected that. We wouldn't have.
Now, can you give a sense of was it a 100x, 1,000x for you? It returned obviously multiples of your first fund.
Yeah.
but you're not allowed to say?
So for that company, I think we invested at around a $3 million valuation and exited at around a $3 billion valuation. So.
Okay, so you could do the rough math on it. But how quickly did you make that decision? Because you guys make it within weeks or less than a week sometimes.
Days. That one, we were meeting with them in person at Techstars, me and one of my other partners, Jeff Pomeranz, and it was so obvious they checked all the boxes. We offered them the investment at that initial meeting.
Pretty impressive. And is that something that you guys still do till today, where you're making a decision within that first meeting or within the first week of meeting them?
Yeah, that's unusual, but that's, if a company checks all the boxes, yes. And then again, we're giving someone a conditional yes. There's still diligence where you have to provide the materials that proves that what you've represented are true. I would say that in today's world, we're a firm yes or no in less than a week, almost all the time. And often that's anywhere between a day and a week. And then after that, there's a diligence process where you have to validate that what you've represented is true. And that's when we're sort of doing all the sort of standard looking under the hood stuff.
Dave, obviously you've had a ton of success over the last decade with your model so far. I'd love to ask you though, sort of how things have changed in the last couple of years with obviously AI and a lot of technology becoming cheaper and cheaper to build. With the decreasing cost of building software, a lot of companies, even in our current fund, are outpacing the amount of money we've given them in their first round of funding in revenue in the first year and are essentially profitable or close to break even and may not even go down the venture path. So how is the decreasing cost of building software products influence your investment strategy, if at all? And what opportunities are you seeing in that early stage landscape because of the advantageous ecosystem of what AI tools have offered?
That's the biggest transformational change in the tech world. And it's really an acceleration of a multi-decade trend. And that's what we've been able to take advantage of and sort of been in the right place at the right time. So if you go back to like the mid 1980s, it probably cost $20 to $40 million to build a first version of a software product, get it to market because you had to go to distribution, get in a retail store, and then you'd prove or disprove if it would, be viable in the market or not. By the early 2000s, it was down to, 4 million, and that seemed so cheap at the time, I remember, and it just kept going down. It's probably $1 million by 2010. And then from our perspective, the big change is from 2010 to maybe 2016 or 17, it decreased by 90%. So when we were looking at companies in 2012 and 13, most companies were still pre-revenue because you needed $500,000 to $1 million to get most products to a state where you could generate revenue. And by the late 2010s, that had completely changed. If you were a team of technical founders, you could do it for zero, very commonly. Maybe a large enterprise product, high-ticket enterprise, still needed more money. And now in today's world, it's just, AI has come and accelerated that even more. So, in today's world, we're sometimes seeing founding teams that have bootstrapped up a $5,000 a month enterprise product with multiple customers. And that was just impossible in 2018 to do. And suddenly that's happening with more regularity. So what's interesting is during this time, over the last 10 or 20 years, the cost to create your initial version of a software product fell through the floor. But every other aspect of building a startup, scaling out sales, marketing, rent, all these other things actually might have even gone up. So it really helped us because, that's, that cheap ability to build a first version of a product is where we benefited the most. What I think the big change that sort of AI has enabled is it streamlined operations now too. So it's now not just building that product that's cheaper, but it's, your content marketing can be done more cheaply. Your customer service and support can be done more, less expensively. And so suddenly now in the last few years, operations and scale is happening at greatly reduced costs because of AI. And that just never happened before. So that's boon for us.
What's your lowest employee count company, Dave, in tremendous success? Like any companies with like 5 or less employees that are, striking hot?
Yeah, we have one or two that are like that. They're sub 10 that are growing really quickly right now, though I don't want to necessarily say who they are because they're growing sort of under the radar.
No, for sure. You don't want to jinx it, of course. Yeah, but it's phenomenal that we all have one.
I think what's happened is like one of the things we've noticed is that when you look at our enormous portfolio of 2,000 plus companies, a lot of our winners go down the traditional venture capital path, right? Which is very normal. But some of our largest winners never went down the venture capital path. They got capital efficient quickly. And maybe they raised nothing, or they raised a really small round from even non-traditional investors. So they just did a seed round at one point, and then they became wildly profitable and grew. And universally, most people never have heard of those companies because you get your press, when you do these large rounds with big name investors. But because there's not a lot of dilution, the founders just do incredibly, and the early investors do really well too. And one of our premises is that if you take now, let's say 2024 to 2030, I think we're going to see that trend really accelerate. Like we've had some talks internally how we're probably going to have, 2 or 3 companies between now and then that become $1 billion plus companies with, sub 100 employee headcounts and maybe even some sub 50 employee headcounts. And that was just unheard of almost.
I mean, that is what true venture capital is.
Yeah.
Right?
And that's, again, most people, when they think of AI, they think of these foundational models that are, that they're very familiar with, that the consumers use. But really the big impact that we see is actually startups using AI, both in their products, but also in their back ends to make everything they do more streamlined and efficient. And that's really sort of the invisible impact of AI that's changing this tech startup landscape.
On our last podcast with the head of capital from RBCX, John Ristigar, we talked about this capital efficiency ratio to exit value. And there's a data point that he brought up, which is the cumulative exit value for capital invested in US venture capital in 2013 was 4.2x to every dollar invested. Where when we started sort of tracking, or when he started tracking, we were losing 0.1x because we were an early ecosystem. But now the lines have converged. The US has actually dropped in dollars to exit because there's too much capital going in for some of these massive rounds where the dollars coming out are just not there. But where Canada has made up space is that we don't need as much capital to get to exits as much anymore because of the depreciation of how much it costs to build companies now, which is incredible to see. And it's really good for early stage venture capital investors like us, isn't it?
Yeah, it really is. And I think there's 2 trends that are just so healthy for the ecosystem that have come out, in the last 3 to 5 years. So one, we've talked about a bit, emergence of sort of AI tools and AI, functionality in your back end. But the other is the whole valuation bubble and popping and collapse, valuation collapse that the tech ecosystem has seen. It's causing a massive amount of pain in the startup world for raising capital for next rounds, probably even more pain in the venture capital world for raising next funds. But there's a big silver lining, which is because we had this decade of tailwinds and increasing multiples and zero interest rates, and it was so easy to raise these large rounds, we really brought up an entire generation or two of entrepreneurs who viewed the goal of starting a company as always raising that next round. It's almost like we had Silicon Valley, the TV show had become self-fulfilling, and entrepreneurs viewed success based on the rounds they raised and who they raised it from. And I think what we're seeing in our portfolio and across our founder ecosystem is that this whole next generation that sort of come into the market in the early 2020s is now realizing just by default that the goal of starting a company is to get it growing and profitable. And that defines success, not how much you raise and who you've raised it from. And I think that is just so healthy for the startup ecosystem throughout, whether it's Canada or the US. And we're just going to have much more better run companies, much more capital efficiently run for at least a number of years. And if we flash forward 6 to 16 years, there'll be another bubble that forms and pops. And in a few years before that, we'll have some irrationality again, because we always do.
Yeah, of course. It always happens, ups and downs. But one thing I want to ask you is your sort of philosophy on how QSBS, qualified small business stock, and the tax exemptions that come along with it are impacting your investment model a bit and how it enhances returns for your investors.
When we designed our entire investment philosophy, we didn't even know that this was all done in the late 2000s, early 2010s. We didn't even know about QSBS. So nothing about our investment strategy is was created with QSBS in mind, because QSBS really didn't become impactful. I forget, it was the end of 2011 or somewhere around there where it became 100% exempt from taxes. But it turns out that the investment strategy that we designed for what we think is sort of optimal risk-adjusted returns, we're doing what the government wants to incent, which is we're very early dollars in, taking some of the highest risk. And that's where we benefit both from QSBS, with everyone's familiar with probably listening to this. There's also a section of the
5 years hold $10 million capital exemption.
Yeah. And what that is, if you invest in what's a qualified small business company, which most US C Corps that are tech companies are, if you hold that investment for more than 5 years, the first 10 million of your gains is tax-free. And it's not 10 million at the fund level. Each of our investors gets their own 10 million, right? And there's also another section of the IRS tax code that most of the venture capital world's not familiar with because it's not relevant to them. It's called Section 1244, and it's really relevant to us and to individual angel investors. And what that section of tax code says, if you're part of the first $1 million into a QSBS company, when you lose money, your loss can be an ordinary income loss instead of a capital loss, which is huge.
Wow, that's great.
And so it turns out our investment strategy is one where we invest in lots of companies. More than half go to zero. And most of those that go to zero can be ordinary income losses. And that's something we didn't plan. It's just we discovered that exists in the tax code after we went live, and it's a huge benefit. And if you're an angel investor, you probably know this.
When do you recognize the loss, though?
Yeah, so you recognize the loss when the company goes to zero and you write off the company.
Okay, so when it's officially written off, then you'll issue a slip, a 1244 slip, saying you can write off your proportionate ownership of that loss.
Yeah, it goes on the K1s we give to investors. It's got a section that lists the 1244 losses. And what's nice is that's just, a deduction against income.
Yeah, we definitely need something like that. Plus, we need a step up in our capital gains exemption. Ours is tiny. It's around 1.3 million for a 2-year holding.
The thing is, Canada does it very differently than the US. So most of the tax incentives or the government incentives are on the back end. So these are things you're getting once you've made a profit and you get some sort of a tax break. Canada, I think the government gives just as much, if not maybe more subsidies to the startup ecosystem. It's just that they're front loaded.
Get SR&ED, which is big, but yeah.
Right. SR&ED is enormous because that allows a lot of companies to succeed that wouldn't have. It allows a lot of companies to raise less capital early on, which is less dilution for founders and investors. So while you're not getting as many of the tax breaks on the back end, you're getting so much more incentives and subsidies on the front end. It's essentially, I think, a wash. So that's why we don't hesitate to invest in Canadian companies, even though we can't get that QSBS tax break or that Section 1244 break on a Canadian company. We feel that the subsidies on the front end, all the SR&ED credits and all the other, federal and provincial subsidies more than make up for that.
I got to ask you your views on some of the incubators and accelerator programs that have been evolving over time. Obviously, you're investing sometimes first check in, repeat founders, like you said, rounds maybe 500K or so. I mean, 500K is what every YC company essentially gets if they raise another round of demo day. And the valuations, as we've seen in the last batch, are quite high. 4x higher than what your maybe average entry price is. So how do you think about the accelerators and incubators out there these days, and what challenges do you think they face in today's market?
We're very synergistic with the accelerator ecosystem. So we are actually minority owners of a couple different startup accelerator organizations. We work really closely with managing directors of a much larger number. We're generally going in, because we make such quick decisions, we don't really distract the founders mid-program. So we'll often get introduced to companies mid-program or on the way in and make a lot of investments then. We probably make much fewer investments at demo days of programs. And another one of the really big storylines of the last 15 to 20 years, and it's maybe more or less 10 to 15 years in the US startup ecosystem, is just the appearance and explosion on the scene of startup accelerators. I think what most people don't understand is it's a really difficult business model to get to work because you're investing so early, and most of those companies are pre-revenue, more often than not. And the life cycle is so long. And until very recently, almost no institutional capital ever flowed into accelerators. And it's easy to get a startup accelerator launched, and you can sort of get your personal network, or you can do some, fundraising from local angels, some local organizations to get off the ground. But you really need to be able to get, find an LP base that's willing to put money into your funds for 8 years straight before you see liquidity.
One thing I'll just ask is sort of like how the pressure to raise from some of these accelerators is still relevant, right? Like getting funding is what they thrive themselves on, right? Like getting your either pre-demo day funding or post-demo day funding. Does that jive well with your strategy of venture capital? Because it sounds like you want capital efficient businesses almost.
Yeah, it depends. So it varies a lot by accelerator. I think we're big fans from sort of a financial engineering perspective of what YC has done. And they're basically attempting to mint unicorns over and over and do it with large numbers. And they're pretty transparent about what their math is. But they're doing it in a way where they're pushing companies to raise a lot of money and go on a very sort of high risk growth trajectory.
Yeah.
I think that's right for some subset of the entrepreneurial ecosystem, and it's not a great fit for others. I don't think, startup accelerators vary so much in the profile of companies going through them and their trajectory. I think one of the challenges in the US ecosystem, or really everywhere, is that nobody really knows what the financial returns of startup accelerators are. They can't publish them. They're not, the SEC wouldn't allow them to. And therefore, when the press does rankings of accelerators, the only thing the press really has to look at is what funding rounds have gotten done and by what profile of investors. And so if you're a startup accelerator, you sort of live and die by what funding rounds get done by your companies after they leave your program. And you can have companies...
Not on the capital efficiency of those startups graduating.
Yeah, if you have companies that are doing incredibly well and don't raise a lot of money and have an exit and you get great returns, that doesn't juice your rankings in the press. The only thing that the press has...
Kind of like VC funds though too.
Yeah, that's correct as well. Yeah, I mean, a lot of our biggest winners have had almost no press and nobody knew they existed until they sold.
Exactly, yeah.
Because they had very few funding rounds.
It feels like times are changing a little bit, Dave. We've also seen a lot of turnover in the last few years from either senior GPs leaving storied franchises. We saw recently Brian Singerman leaving Founders. We saw Keith Rabat move from obviously Founders back to Khosla. You've seen a lot over, your time working in venture capital. What is it that keeps you excited about still playing on the field and keeping Right Side going forward that maybe some other people are just tired of?
Well, what gets me going and gets me really excited to get up and go to work every day is really, I view, we're not structured like a typical venture capital firm. Like we're structured more like an operating company. So we view ourselves really as a tech startup whose business just happens to be funding other startups. So from my perspective, I've founded 3 different startups in my career. For a little over a decade, I founded and ran a computer hardware company. For much of a decade, I founded and ran a software company. And then for now, the last 15 years, I've founded and run a venture capital company, for lack of a better term, because we're not really structured where we have partners that are the luminaries that pick companies, sit on boards, and everyone else sort of supports that activity. We have all these operational business units internally. And it excites me that we're innovating on the funders side of the fence because I think there's just way too little innovation. I love when I see other firms or other people trying new things on the funder side. I think there should be more of that. And what I love too is, the role I play. Most of the deals we invest in funnel through me, but I also do a lot of operational support and mentoring with companies. So I've been an entrepreneur my whole life, and I really miss a lot of that. But on the flip side, in a normal day, I might talk to, a half dozen founders or sometimes more, and they could be new founders that we're looking at evaluating for investment. They could be one we invested in recently that now it has a few $100K of ARR. It could be one we invested in a while ago that has millions or tens of millions of ARR. And just the ability to get to talk to entrepreneurs and try and help them succeed at all different stages of the life cycle is just thrilling for me. And I think that's what gets me up and going, gets my juices pumping.
That's awesome.
It's hard now in the last couple of years because it's painful. Like it's most of the conversations I have with founders, even in our portfolio ecosystem, is about how hard it is to fundraise. How are the sales headwinds into enterprise affecting business? All of this.
Yeah.
And that's just part of the natural cycle. I wasn't having many of those conversations in the many years before because, we were in an inflating bubble, and it takes a while for a popping bubble to reverberate through the system.
Yeah. But what's keeping me excited, Dave, is that the founders who are having those conversations now, they also were the founders who had those conversations a couple of years ago when everybody else seemed like they were making money hand over fist. And so they developed the muscle of how to deal with those really low lows and how to not get too excited about those high highs. And so when these things happen now, and it's not the first time, they're much more equipped to handle it, I feel. At least some of the founders that are going to break through that wall much easier than some of the ones who are encountering it for the first time when they burnt too hot, too close to the sun, and they almost have no chance of fundraising again. So we're seeing two types of founders emerge.
That is completely true. And one of the things that excites me in that work, both of my partners had, 2 decades of entrepreneurial experience themselves. And so between us, we're just like, we've got 60 plus years of entrepreneurial experience, and that's not even counting right side capital as any of that. And in spite of that, we're still constantly amazed at how resilient and scrappy entrepreneurs are and can be. It's just never ceases to amaze us, and it's just so eye-opening and exciting and inspirational.
Yeah, absolutely. Dave, I got to ask, how many companies do you think are in your CRM right now? How many companies have gone through your CRM?
Just of what we've invested in, it's over 2,000.
And how many have you seen, though, that you didn't invest in? 100,000?
Yeah, probably.
That's a lot of data.
We don't even keep all those. We purge stuff.
Do you guys use a lot of data science work? A lot of it's AI driven now, but are you guys doing a lot of in-house customization around sort of all your qualitative stuff?
Yeah. So what we did when we started investing, at the beginning of 2012, there were not these software products that exist to help manage deal flow, manage portfolios, and anything that did exist didn't fit for us. So we basically looked at what was out there, and rather than build something from scratch, we took a CRM and completely customized it, built some custom apps, and are using that to. It's our internal cloud database system that runs our entire operations.
Still the same one that you built on from the beginning?
Yeah, from my phone, from my computer, any company, I can see all the information about what it looked like when we invested, how it's evolved over time, what investments we've made, what they're marked at now, see copies of the funding round docs. So that's just there for every company in our system, and it's really easily accessible. Takes a lot of labor to get all that data in there. So we have a team of 3 data analysts that spend the vast majority of their time getting, updates and information from our companies into our database in both structured and unstructured data.
Unbelievable.
And we're leveraging AI to do that to make us more efficient, but it's still a lot of labor.
It's still a lot of labor. Hey, that's what those management fees are for, though. That's amazing. Before we wrap things up, we always ask our guests for their fast favorites. So first off, your favorite podcast.
So I will give a non-tech one that I've just loved over the years. I think the Slow Burn podcast series is amazing. And I love how each series is on a completely unrelated topic. And I feel like they're the right length, and I learn a lot.
Never heard of it before.
It's interesting. I came across it originally because I don't know if I heard a commercial or what it was, but I was interested in a season that had to do with sort of the Tupac Shakur, Big E rivalry in the 90s and the 2 murders that happened. And so I went to it and I'm like, oh, this is season 3. Let me see. What are seasons 1 and 2 about?
Oh, wow. You went right back to the beginning.
And season 1 was about Watergate. It was like an 8 or 10 episode.
Fantastic.
And so I said, I'll start with that. And I learned so much. It was incredible. Season 2 is about Monica Lewinsky and Bill Clinton. And then I listened to the Tupac Big E series. And anyway, it's non-tech, but I just...
Fantastic. I have to check that out.
Get sucked in. Yeah, I've recommended it to a lot of people.
Okay. Do you have a favorite newsletter or blog you subscribe to?
I don't. I'm a wide reader of a lot of different blogs, a number in the tech VC world. I'm also always interested in just sort of economics, finance, read a lot of different things. So I don't think I have a specific one.
All right. Your favorite tech gadget?
My favorite tech gadget... I like to play golf, even though I'd say I would suck at it. So I just think they're not new, but golf simulator technology just keeps getting better and better. I don't have one.
They are popping up everywhere around our neighborhoods. There's literally ones on every block.
Yeah, I have a back sunroom and my ceiling is just too low. Like I would be able to swing like a 7-iron and nothing higher. So I wish I could have one though.
Nice. Next is your favorite new trend?
My favorite new trend, I think in the startup world, it's something we talked about, just how without coaching now, because of everything that's happened in the last few years, entrepreneurs just naturally view profitable growth as the ultimate goal of starting a company. And that, I can tell you, in the 2010s, that was never entrepreneurs' default goal. And it is now. It's so awesome.
It probably took a lot of people by surprise. They spit out their coffee if the first thing an entrepreneur said, what's their vision for their company? And they'd say, to be profitable.
Yeah.
But yes, it is coming back. I appreciate that. Next is your favorite book.
So I'm going to give a book that I think every entrepreneur should read. It's not necessarily my favorite all over, but it's called Extreme Ownership. And it's written by 2 Navy SEALs, Jocko Willink and Leif Babin. And it takes all the lessons that they learned in the military about leadership and how to have a distributed team that has ownership and can make decisions, and how to evaluate your success and failures with complete and utter honesty and ownership.
Very cool.
And it will just make you a better person. And with certainty, it'll make you a better entrepreneur.
Oh, excellent. And last but not least, your favorite life lesson.
Biggest life lesson is you have to believe in yourself first and foremost, and go by your own judgment as to what you think is possible and not possible and are realistic goals or not. And you have to ignore what others tell you. It doesn't mean you don't take in others' advice, but there's so much that I've been successful at in life that others have told me is insane or you should never do. And I'm constantly catching myself when I talk with entrepreneurs all the time. Just a quick story around this. My first company I started out of college, a computer hardware company, in 1992, there's no internet. You couldn't learn about anything. You didn't know it was crazy or not. I fell backwards into $10,000. That's a story for a different time. And my girlfriend put in $10,000 that she had. And we started a computer hardware company where I did my business model was that all I had to do was be profitable by month 3. And if we did that, we'd be fine. Now, the only reason we started that company is because no one was around to tell us that was the most insane idea they had ever heard. And so I committed about 20% of our budget to rent for like the first year, found this cheap place, a third of our budget to advertising just for the first 3 months. And we were profitable after month 3. Now, if an entrepreneur came to me today and they were going to have a retail store and they're going to have a business model like that, I would tell them they were nuts and they shouldn't do it. But then I have to catch myself because, it works. So, it's ultimately believe in yourself. And that's just what matters the most. Take other people's opinion and judgment into account, but it's all about you.
Yeah. I mean, ignorance is bliss, for a lot of entrepreneurs sometimes. I remember when I sat down with the first advisor or kind of mentor person I was looking up to in VC and asked them for some advice. And they said, well, what do you want to do? I said, I want to start an early stage VC fund. They said, don't do it. That was the advice, probably because it was so hard for them. But I think that's what inspired me to actually go through it. If they would have told me, yeah, good luck, it's going to be easy, I would have given up pretty quickly, maybe. So it's very interesting to hear you say that. Well, I appreciate you joining us in the tank today with co-founder and managing director of Right Side Capital, Dave Lambert.
Yeah, great. Thanks for having me on. I really enjoyed it.
Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcasts, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.